We wanted to sort of demystify VC a little bit. I've learned a lot about VC. I've been in it sort of, I think, entering my 4th year. So it's a little bit about me. But I was a former product leader, as Shirley mentioned. So I spent 16 years in Silicon Valley building products, and I turned accidental VC 4 years ago. I have learned so much over the last 4 years, and I'm hoping to sort of impart some of that knowledge for you. Hopefully, get you in a better place to be able to increase your chances of raising your next round of capital. I'm a founding partner of a new venture firm called Spero Ventures. And then outside of work, I have a lot of different interests and passions, and I'm a proud mom of 3 boys, high schooler, middle schooler, and elementary schooler. You can connect with me on social, so at Twitter, I'm at PocoGirlHigh. And then also feel free to connect with me on LinkedIn, as well as Medium, because I do a little bit of blogging as well. And then a little bit about Spero Ventures. So we're an early stage, $100 million venture fund. I think what makes us really interesting and unique is our mission and values alignment. So our LP and all of the partners of Spero, there's 4 of us, are either founders or executives of eBay and Tesla. And these are 2 sort of iconic generational companies that have produced both purpose and profits. And those are the types of companies that we invest in. So we say that we invest in the things that make life worth living across our well-being, work and purpose, and human connection. And then we typically come in a little bit later than maybe some of you are, so kind of late seed or early Series A. And the reason why I say late seed to early Series A is that the goalposts keep changing, right? So what was yesterday's Series A might be considered today's late seed. And so the goalposts keep changing and the terminologies keep changing. The important thing is if you're looking to raise $3 to $12 million, we want you to come talk to us. And so there's probably a little bit of market validation, customer traction that we're looking to see. And we write $2 or $3 million checks, and we will always have a concentrated portfolio. So out of this fund, we'll only do about 16 or 18 investments. And we like to have deep engagement with our companies. And then just to get started, this is all the things we'll cover today. I won't read them off, but it's a lot. So hopefully, this is the first time I'm giving the talk. So hopefully we'll be able to keep it to about 40 minutes or so and save the remaining time for Q&A. If I go too fast, if you have questions, feel free to stop me. And this is the first time I'm giving this talk. So if you like it, you hate it, we'll send out an NPS survey afterwards and that will let me and Sheila know. Okay, so really the first question I think to ask you is, do you believe that you're building a rocket ship, or that your company has rocket ship potential? Raise your hand if you think that you're building the next rocket ship. Okay, I like it. About half the room. And raise your hand if you're not so sure. Just one person. Okay. Well, for you, so what's your name?
Roger,
do not raise VC. Just keep bootstrapping as long as possible. So VC really is truly only for less than 1% of startups, right? And so I think many of you understand this, but when you raise money from VCs, they really expect outsized returns. So they're looking to fund the next unicorn company. And if you can't get there, then there's all sorts of trouble that is in store for you, because VCs are incentivized to have you go on that rocket ship ride and get to 100 million in revenue in 5 years, or they're okay if you crash and burn into the ground too, and they expect it because they've modeled it into their fund economics and fund returns. There's a lot of other financing options. I won't go through them, but the best, honestly, is if you can bootstrap your company, bootstrap it as long as you can, show progress, show traction, show customers, show revenues, control your own destiny, and raising VC is a little bit binary. Either it's really, really easy to raise, or it's really, really hard to raise. And if you start going and having discussions and sort of the market's not biting, it's probably because VCs think that your baby is ugly, but they're not going to tell you that, right? And so the best thing that you can do for yourself is just keep buckling down, keep working on your business, keep working on making progress, keep getting customers, keep getting revenues. And the moment when you feel like, oh gosh, I don't need to raise VCs, that's when all the VCs start coming. So that's the trick there. Okay, so I wanted to share a little bit about sort of understanding VC fund structures and incentives. And if you understand this, you can sort of start to understand or think like a VC. So VCs do raise money too, and they raise from limited partners, and that includes institutions, endowments, high net worth individuals, And the LPs are expecting returns on their money, right? Because the LPs can put money against anything. And so they really are expecting at least 3x the invested capital to be returned back to them. You can sort of see the chart on the right, it's really, really hard to do this, right? So even though every LP is expecting their fund managers to return 3x the fund, only 5% do. In fact, half of the funds out there, the 800 micro VC funds, half of them will not return even 1x the invested capital. But the problem is that it takes a really long time for LPs to figure out if fund managers are any good. So 10 plus years, because that's how long it takes for many of these companies to successfully exit. And so in 10 years' time, half of the funds that exist today will go out of business because they weren't able to return capital to their LP. All VCs sort of have some calculations that a third of their companies will just die and never return back the investment dollars. A third will get acqui-hired and return back some or at least their investments back. And then a third are really the winners of the portfolio. And hopefully the VC is seeing 10x the investment in that startup, or in great cases like an Uber or a Slack or a Zoom or a Lyft, it could be 100x the investment in the startup. And that's what VCs are shooting for, but they've also done the calculations that they know that these other scenarios are just as equally likely. Most of you know this, VCs operate on a 10-year fund life. It's sort of 22 model, right? So 2% management fee. So if we're a $100 million fund, $2 million gets pulled out of the fund to run our fund operations, pay our salaries, use it to sort of pay for travel and office space and any other expenses required to run the firm operations. But these management fees over the course of 10 years needs to get paid back before we see any carry. And carry is the percentage of the fund profits that we can pull out and sort of reward ourselves for doing a good job. So as an example, and I'll sort of throw the question out at you, if we're a $100 million fund and at the end of 10 years, we have generated $150 million, is that good or is that bad? What do you think? Bad. Tell me why.
You said the LPs need 3 times the return, like it's
okay. Yeah. So it's 1.5, so that's not great.
Yeah.
Any other? Tell me a little bit more. 50 million? What's that?
No. Put that in the stock market, 10 years.
Yeah. So let's do the math on that, right? So 50 million is profits, but again, the expenses over the course of the 10 years was 20 million. So that gets deducted, and so that's 30 million in profits that gets split between the LPs and the VCs.
2% per year.
2% per year, yeah. So $2 million of a $100 million fund. So over 10 years, it's $20 million of expenses that we need to pay back before we see any carry. And of the remaining 30 million, 80% goes to the LPs, 20% goes to us. But if you do the math, so 80% of 30 million, that's just 24 million. That's not a great return. In fact, like the stock market at 6% will give you a better IRR return than this. And for us, even though 20% of 30 million, that's 6. It's okay, but it's split across 4 partners, $1.5 million. It's not enough to fund their yachts or private jets. We're gonna keep working and do better. Okay, so I think most of you sort of have seen a variation of this graph before. So we will see this year, even as a new fund, 1,000 deals. So 1,000 deals will hit our inbox. Of those 1,000, we'll meet with roughly 150 companies. And then of the companies that we meet with, we'll only take about 25 of those companies through deep diligence, right? So multiple rounds of conversations, due diligence, partner meetings. And then of those 25, we'll fund, for us, probably just 5 or 6 this year. And so it's really, really hard to get funding. Sort of do the math, and you're going to get lots and lots of rejections, right? So expect a lot of rejections, unless you're in that sort of special class of founders where it's super easy to raise capital, right? So if you're Elon Musk or Jeff Bezos, you're going to raise capital all day long, or you're a serial founder with exits, or you just launched your company earlier this year and are already at 150,000 in MRR, and I just met with a company today that was that scenario. You'll be able to raise, or they'll be able to raise money, but for the rest of us, it's really, really hard to get money. Okay, so when to fundraise from VCs, right? So a lot of startup founders make the mistake of, okay, I need some money to hire some engineers or to acquire some customers, and so naturally I don't want to bootstrap forever. I'm going to go out and raise, and that's actually not a great time to raise, right? The best time to raise is if you can show accelerated charts that are up and to the right, and that you can demonstrate product market fit. If you can show these two things, it will be easier, but not easy, but easier to raise money. This is the sort of the moment when a VC really wants to get in, probably sort of 8 in this chart here, right before it hockey sticks. But there's some indications that the business is working, and that's when VCs want to get in. Will be your easiest time to raise. So what you want to avoid at all costs is raising in what I call the trough of sorrow. So everybody know what the trough of sorrow is? So, maybe you launched 6 months ago, you got some PR, got a lot of customers, got a lot of interest, and then ever since then it's been flat, right? Don't do that. Don't try to raise then. It'll be impossible for you to raise. And feel free to, by the way, to stop me at any time with questions. Yeah, question?
How do you prove product market fit?
Yeah. I actually I had that in a slide and then I decided to take it out. So there's sort of 2 ways. Well, first of all, product market fit, if you're asking, you probably don't have it, right? And so it is a little bit of a feeling. I'll tell you a scenario of product market fit for us just today. I'm on the board of Women in Product. We're a 16,000 female PM community. We have a conference coming up in November where we are selling 2,000 tickets. Within the first half day, so today, we sold out 70% of our tickets, right? 2,000. So tell me, is that product market fit? Probably, right? So it's sort of like product market fit is really kind of like when you have it, right? Like you can't keep up with customer demand because it's coming in so fast and you can't hire enough people to service that demand. Or like everybody wants to come in and invest in your company because you're getting press to write about you. I mean, there's all these things that, and Mark Andreessen writes a great blog on it of like when you have product market fit, you'll know. Ways to measure it. So there's a couple of things that I like to do to measure it. So if anybody has ever read any of my posts, I'm a huge NPS devotee. So the NPS question is on a scale of 0 to 10, how likely would you be to recommend this product or service to a friend or a colleague? The score that you'll get is negative 100 to 100. The best companies of our generation, Apple, Amazon, etc., they get 70 NPS. If you're doing above 50, that's amazing. And I should probably be writing a check. Most startups, especially in the early days, see a negative NPS. As you're getting better and better, that NPS number will creep up. So I like that. Sean Ellis also sort of has his product market fit question, which is if you can no longer use this product or service, how disappointed will you be? And he's expecting 40% of customers to be extremely disappointed if they can no longer use the service, and he believes that if it's at least 40%, then you might have product market fit. So different ways to measure it, but honestly, it's a little bit of a feeling. Okay, one more question before moving on.
Real quick question. In terms of deal flow,
Yeah.
You had pointed out that there are some entrepreneurs who could just raise at the drop of the hat, right?
Absolutely.
Obviously, you'd like to get in front of those guys if possible, I would think. Maybe not.
Well,
And
maybe.
so then the question is, what is your preferred way of kind of getting introduced to deals?
Oh, okay, yeah. So I'll cover that in a little bit. Like, what's the best way to sort of get in front of investors? So if you can hold that thought, it's coming. Okay, so there's a lot of confusion these days around what's pre-seed, what's seed, what's Series A. The goalposts keep changing. I don't really understand. And the way I really think about it is sort of stages of your company, right? So if you were still in kind of ideation concept phase, you're not yet ready to go and talk to professional investors, and that includes professional angels as well. You're sort of at the pre-seed stage where you want to honestly bootstrap as long as you can, but if you absolutely need to go out and raise money, I would go and raise it from friends and family, and just raise as little as you need in order for you to successfully launch your product and get some early customer validation, right? Some early users in. Once you launch your product and you've gotten some customers and it seems to be working, right? So like the metrics are going up and to the right over 6 months. There's some customer love around the product. You feel like the unit economics are working. that might be a good time to go out and raise sort of your seed round. Typical seed rounds these days are $1 million to $3 million raise. Of course, if you're like one of those serial entrepreneurs, you could raise a $20 million seed round. That I've seen that. But for the rest of us, it's a sort of a $1 to $3 million raise, and valuations keep creeping up. So I've seen sort of seed valuations at 3, 4, or 5 million. I've seen it as high as 10 million on average recently, especially all of the YC folks are raising at valuation caps of like 12 million plus. So so the seed rounds are creeping up a little bit too. But Series A, and this is sort of where most VC funds come in. So I'm not talking about micro VC funds. True VC funds, the Sequoias, the Greylocks, the Andreessens, et cetera of the world, they really want you to have proven product market fit. And the raise these days, yesterday's Series A might have been 5, 6 million. The raises these days I see is very typically 10 to 12 million Series A when you have product market fit. And what VC funds are trying to do is give you jet fuel to sort of fuel that jet, right? And then the valuations can sort of range, and the valuations will range based on a number of different factors: what type of company you are, the growth rate, how hot the market is, how hot the team is. But just to get an idea, because I do get a lot of founders asking me, like, how much traction do I need in order to raise a seed, or how much traction do I need to raise an A? This chart comes from my friend Rob Go, who is part of Next Few Ventures. This, I think this data might have been about 1.5 years old, so the goalposts might have changed since then, but it's a good proxy. So at the seed, it really depends on what type of company you are. So if you're a SaaS company, you really want to be at sort of 10 to 50,000 in MRR before you start raising. 10,000 these days is low, and so you might have a harder time raising. 30 to 50,000 is kind of what we're seeing a lot of when people go out to raise. And even then, it's not quite in the bag yet, because a lot of other factors sort of have to be in your favor. If you're building a hardware company, right, like you probably don't have any revenue because it's such a capital intensive business, and that's okay. If you're building a e-commerce company, the revenue is expected to be higher because it's one-time revenue versus recurring revenue. And so these are sort of good proxy numbers. The important thing in terms of running a good fundraise process. So when you are ready to raise money, so you have something that is working, the numbers are up and to the right, you have what you believe is sort of customer validation, market validation around your product, let's go and raise some money, right? And what you're gonna do is not work on your product or startup anymore, right? Like you are gonna delegate that to your co-founders, your founders, like you are gonna be spending the next 2 to 3 months doing nothing else but fundraise. And the reason why you don't want to drag out your fundraise process is a number of things, right? What you want to do is you want to first get that money in the door, focus on that, and then go back and run your business. You don't want to drag it, out forever where you're sort of juggling between two things, because you're never going to do both things really well. The other reason why you want to sort of work on this full time is because you do really want to create some FOMO around your round. And the best way to create FOMO around your round is to get all those investor conversations to take place all at once, right? And then to sort of, and I'll sort of share a little bit more of sort of the strategy of secrets, but you want to sort of create sort of some momentum around your round, which is, okay, I just started my fundraise a week ago. I already have $500,000 committed from angels. I only have $1 billion left. Do you want me to hold your allocation of the round? I'm expecting, I have 30 more investor meetings coming up in the next 2 weeks. I'm expecting to get a term sheet or two. A couple are already diligencing me. Do you want in or not, right? And you want VCs to get you to either a quick no, which is fine, right? Because you're going to get 99 no's, or you're going to want them to be excited and hopefully get to a yes. And so the goal here is to raise more money faster. And that's why you want to run a process. So to start, you're going to want to build out the investor list, right? And so this spreadsheet sort of shows the type of spreadsheet that you're going to create. And many of you are in sales, right? You're trying to sell to businesses and enterprises. The same way that you would run a sales process, you're going to run the fundraise process, right? So in the sales process, you have your ideal customer profile, or ICP. Here, it's who's that target investor? Where that VC is most likely, well, where I'm going to most likely be in that VC's top 1%, right? And so if you are raising a seed round and you're talking to a Series A investor, they might take the meeting, but it's going to be a waste of your time because they'll never invest in your company. They're just fishing for information, right? If they just don't invest outside of the U.S. and you're incorporated outside of the U.S., just don't bother talking to them again because they're not going to invest in your company. What you don't want to do is spend your time talking to investors that have a very slim, almost no probability of investing because you're going to use that time more productively elsewhere. It's all about sort of opportunity cost. So make sure that every one of these investors that are in your list are the target investors. So they're investing in your sector, at the stage of the company that you're in the same geographies where you're headquartered, and that's really, really important, right? It should be easy if you do your research or have an intern do your research of building a list of 50 to 100 VC funds. There's lists that are out there. There's 700 or 800 micro VCs right now. So they're out there. Just do the research, build the list, go talk to other founders before you even start to fundraise. Talk to as many founders as you can. See who's in their cap table. Ask them if their investors might be interested in the type of company that you're working on. And ask your advisors, ask friends, right? You want to sort of collect this list and build a list. Okay, so then the question that was asked is how do you reach out to VCs? And I think everybody sort of inherently knows that a warm introduction is better than a cold email, right? And so if you can avoid the cold email, I would highly, highly recommend that you do so. If you don't have a network, there are ways for you to engage with these investors even without a network, right? So follow them on Twitter, engage with their posts. There are ways for you to start building relationships. Go to their events. There are ways for you to start building the relationships where they would be maybe more receptive to take a sort of cold inbound email from you. If you need to send a cold inbound email, if you can personalize it in any way, that will help. I think most VCs do read all of the emails that come into their inbox, but if it's a generic, it was clear there was a copy and paste and sort of put everybody in the 100 people in the BCC line, that's never going to work. So, but ideally, you get a warm intro from another founder, an advisor, another investor.
Are you finding that the quality of the intros is good for you?
In terms of cold inbound?
Well, not cold inbound. I'm saying that I would infer that you basically take warm leads that come in through your network. Are you finding that your network is of value to you in terms of?
Sure. Yeah. So the network consists of many different types of individuals, right? So it includes other co-investors, and oftentimes investors don't like to send over deals that they passed on to another VC because it might reflect poorly on them. Now it's okay, and I have done this. I might pass on a deal that I liked the founder, I liked everything about their business, but unfortunately it was too early. I might pass that on, and I will state that, which is we're not investing because it's too early, but I met the founder, seems really amazing, seems like a really interesting solution in a big market that they're playing in, and the investor will if they're investing at that stage and that type of company, will be more receptive to taking the meeting. But if I probably wouldn't spend any social capital sort of just sending around deals that I didn't like, right? And then of course sort of if it's a founder within our portfolio that's referring it, I'll pay close attention. So there are certain groups of people that I'll pay more attention.
For your inbound, you probably have a list in your mind of, okay, I'll listen to these. Yeah, I'll take these more seriously than these. Are there people in that list of, these are people to take seriously? Obviously, other co-investors, people who are putting real money behind it.
Yep.
Are there lower tier that maybe if it's interesting, I'd look at the back?
So I will say that I do think most VCs will go and read every single email. So it's not that put it in.
I don't really
delete. So they'll take a look at it. But if there are certain co-investors that they know are good investors or founders within their portfolio, or a network that knows the VC very well, knows exactly what we like and to see, we'll sort of maybe spend another 2 minutes on that email than we might normally otherwise, for sure. Okay, so after the warm intro, when you get the VC to positively respond, this is a mistake that I see a lot of first-time founders make, which is, oh, great, are you available next week? And even if the VC were available next week, you don't want to schedule it next week, right? So you want to schedule it such that you are lining up 50 meetings over the course of 3 weeks, and you want to you want to do 4 meetings a day, because you're going to try to generate sort of momentum in the round, and just sort of spreading out the fundraise discussions doesn't create any momentum in the round. When you schedule the meetings, I would highly encourage you to schedule all of the angels and the smaller checks first, and then wait for the bigger funds until the end, for a number of reasons. One, you're going to be much better at your pitch by the 30th conversation. And so you really want to sort of save those important discussions until the end, where you've been asked the same questions over and over and over again, and you're going to be sharp and succinct and crisp with your answers. But there's also another reason to schedule those angels first, because those angels, they don't have to get buy-in from anybody else, right? Like, they can make decisions pretty quickly after 1 or 2 meetings and maybe some light diligence. And so what you can do as you enter sort of VC meetings is, I'm opening up $1.5 million seed round. I already have $500,000 committed in angels. I only have $1 million left of allocation in the round. However, I'm just starting early conversations with VCs. I have 30 more VC meetings lined up in the next couple of weeks. Let me know if you're interested. If you're not, that's okay. But if you are interested, if you can just let me know by, if the meeting's on a Tuesday, can you let me know by this Friday if you're interested? But you really want to sort of create that sense of FOMO. But one thing to note is that FOMO does need to be real, right? Like, you can't lie, you can't make it up. It really does have to be real. And so that is why it's important to sort of do this fundraise where you're scheduling meetings 2-3 weeks out, you're getting all the angels in, you're sort of creating some momentum around the round. Question?
Yeah, real quick. So, what do you expect in a warm intro email or any intro email? Like, what are the few key things, right? Like, that you are looking for?
Yeah, you must have seen my slides, because the next one, this is the intro email, right? Was that the question?
Yeah.
Okay, so the slide right before it, and I really won't spend that much time on the slide right before it, so I think everybody knows kind of, right, the elements of a great pitch deck, because there's a lot of stuff that's out there. You can just Google, examples of great pitch decks. In my slide, I linked to Front. Matilda had multiple term sheets on their Series A. She sort of wrote about it. She did a postmortem, and she also shared her slides. It is a great narrative. You should go and take a look. But there's a lot of examples out there. Problem you're solving, what's unique about your solution, how big is the market, what traction are you seeing, who's the team. This is pretty common and standard. And my pro tip here is hire a deck designer if you're not great at sort of designing it yourself. It will, hopefully we're all product people here, right? Like, you wouldn't put out an ugly looking product to your customers. So consider an investor a different type of customer, and maybe spend the money on a good deck designer. But in terms of the investor, right? Like, investors really want, in 2 or 3 paragraphs, a lot of the same elements that's in your pitch deck, right? So they want to know, what's the problem that you're solving? What's unique or different about your solution? How much traction do you have? Tell me a little bit about the team. Tell me about the fundraise, right? And you got to do that in 2 or 3 paragraphs. Now, this is probably a little bit more than 2 or 3 paragraphs, but SaaStr published a few good examples of cold inbound emails that they received. These weren't warm, but cold inbound emails that they responded to, because it introduced all of these different elements. Question I often get is, should I include a link to my pitch deck or not? Absolutely, you should, especially if you're trying to raise money from VCs. All VCs will ask for it. So if you don't include it, they'll immediately reply saying, great, can I see a pitch deck? So just go ahead and include it. I know there's a lot of debate around it, but I won't take a meeting without seeing a pitch deck. So, and many VCs feel the same way. So the pro tip, right, is especially if we're going to do the cold inbound, is tell me that a little, why I would be a great investor for you, right? You're building a purpose-driven company that can get to venture scale. You love what I wrote about the things that I get excited about. You've been following me on Twitter, whatever it might be. But make it so that it's personalized and real, and that'll be effective. Did that answer your question?
Yeah.
Okay, great. Okay, next. So, okay, you have 30 meetings lined up, or maybe 50 meetings lined up over the course of 3 weeks, right? During sort of that 3-week window, where you're getting ready for those meetings, you got to do a lot of work. So the first thing that you're going to do is you're going to practice. And you're not going to practice by yourself in a room solo. You are going to practice in front of maybe friends, family members, advisors in the beginning. And then you're going to go out and you're going to find as many founder friends. And you have a whole room full of founder friends. I hope you get a chance to meet each other and connect with each other on LinkedIn. But you're going to practice with each other. And you're going to ask the founder to give you honest feedback around what he or she thinks. Are you ready for VC funding? What types of questions would they want to know about your business, right? And so you want to sort of practice with as many people as possible, because when you get into that first serious meeting, you'll have sort of all of the jitters and and hopefully the kinks within your story all worked out. So practice, practice, practice. The other tip that I like to give founders is that you want to be prepared for any scenario, right? So you're gonna, and this is gonna happen more than you want it to, but you're gonna get into that sort of VC room and get set up with the tech, and the tech doesn't work, and your slides aren't loading. So you want to make sure that you're able to do your pitch with or without slides. And towards the end, you actually might be more comfortable even pitching without the slides. And I think this is true. Like the last 3 companies that we invested in, the initial pitch had no slides, but it was just them telling the narrative around their company that got us really, really excited, right? So in the beginning, you might sort of rely on the slides, but you do really want to get to the point where you can tell your story with or without the slides. And you should be prepared for other scenarios, right? So if you're the type of VC that I am, I get excited, and so I'll jump in and I'll ask lots of questions, and I might interrupt your flow along the way. It's not purposeful, but sometimes it is interesting to sort of see how founders kind of react. If you get flustered by like me interrupting your narrative, then it's telling. There are other VCs where you won't get anything. They'll just sit there in silence. And you're like, do they like what I'm saying? Or like, are they paying attention? I have no idea, right? And you gotta be prepared for any different scenario, because it will all show up in the pitch meeting. Confidence. This is kind of obvious, but it's surprising how many founders come to meetings with me and they get nervous and they're not able to tell their story. And they might be great founders, but if they can't project confidence, which is, I'm absolutely building a rocket ship, right? I have something that's really, really unique in the market. The timing is right, and the round is moving fast, and I have the right team to execute on it. That if you can't tell me that story and have the confidence, like how am I going to, when the shit hits the fan, am I confident that you can pull it off and you can sort of get over sort of that valley of sorrow? Am I going to be confident that you can hire a great team to work under you? So it's really important to come in projecting that confidence that you are building the next rocket ship. And hey, VC, are you in or are you out, right? So that swagger really does help you. But that swagger hopefully isn't arrogance, right? And so there is kind of a little bit of a difference there. Okay, so some pro tips here. So the best founders that we meet with really do, it's not a one-way dialogue, it is a conversation. So at the end, you really do want to understand, right? Get feedback from the VC of like, hey, did my narrative resonate with you? Is this something that you might see yourself investing in? Get that feedback at the meeting if you can. And then, if there's sort of some positive indications there, ask them about their process, right? Ask them, when can I expect to hear from you? Will it take you a week or two to tell me if you're not interested, or if you're interested, tell me what follow-up information you would need to get excited about this opportunity. So you're really going to try to understand the VC's process and timelines. Every VC fund is very different. Some VCs, especially the ones that are part of small partnerships, they can make maybe decisions relatively quickly, and maybe they don't need to get the whole partnership bought in. Maybe that one partner can just make the decision on their own. And yet, for many of the bigger firms, there is a partnership model, right? And so they might have a second partner meet with you if they are excited about the company, and then they'll do a bunch of due diligence and some customer calls and lots of reference checking, and then they'll invite you in for the partner meeting. And for some VC firms, it has to be unanimous. All the partners have to agree to fund it, and others, it doesn't have to be unanimous. It could be just the conviction of the lead partner. So you really want to sort of understand that in advance. And then the other sort of pro tip I have for you is that the follow-up is so critical. So Andrea, where were you? We met earlier today, and I loved how you followed up immediately saying, hey, here's the summary of the discussion. Here's what I heard from you. Here's like sort of the follow-ups that you said that you wanted. Here's some of the materials that you asked for. The follow-up is so critical, right? Like I'm so surprised when we leave a meeting and then the founder is waiting for me to respond, right? Like you want to sort of thank the VC for their time, and then you want to sort of reiterate what you heard. You want to ask them what open questions do they still have, to get the VC over the hump. Is it about the market? Is it about the team? What can I share with you, etc. So project confidence, but then also the follow-up is really, really critical too. Okay, any questions actually before I move into the next slide? Okay, looks like I have 9 minutes. I'm almost done. Okay, so what should be in your data room? So I'm not going to go through this list, but before you start the fundraise process, it is really, really great for you to have your data room ready. So there's going to be some deal term docs, some financial docs, information about the team, information about IP, so corporate docs, and more information about your product roadmaps, your marketing roadmaps, your sales roadmaps. There's a lot of information that you're going to want to pull into the data room way ahead of the fundraise. Because the moment that you get a VC who might be interested in the round, it's a strong signal to say, great, here's a link to my data room. Go through it and let me know what questions still remain. And there may be additional information that they want to pull from you that you'll eventually add to the data room over time. But you want to get all of the materials, including the note docs, etc., sort of ready with the presumption that, hey, if the VC gets sort of all this information, they're ready to invest. Okay, and then financing instruments, I think given the time, I won't go through this so much, but you'll either raise an equity round or a price round. There's some advantages and disadvantages of both. For equity rounds, you typically will find a lead investor who will price the round, so you'll know exactly how much equity you're giving away. The lead investor can also be very helpful in terms of helping you syndicate out the round. They can be helpful with value add. So we at Spero only do price rounds. We like the price rounds. But there are some cons to it, right? So it takes longer to close. So instead of collecting checks as you go, everybody tends to wire in the same day, and after like a month or two of diligence, you might be ready for those checks to get wired in. But legal fees are higher, so there's lots of pros and cons for both. I think either is fine. There's no one thing that is better than the other. It's really I think kind of like what the market is saying they want to do.
Quick question. So if we are going for pre-seed, seed, or series, any round, right? Like, what's the percentage or equity of the company that we should offer?
Typically, for every single round, you'll expect about 20 to 30% dilution. Now, that might not be true in the pre-seed round, where maybe you're only raising $500,000 and it's not a price round anyways. But as soon as you get sort of that price round, VCs will often want to take 15 to 20%, and there might be sort of an allocation remaining in the round for angels or other people to come in. But at every single round, you'll see about 20 to 25% dilution.
But not true for seed or pre-seed, you said?
Again, a lot of it is how
Just
much are you
approximate.
raising. Yeah. So if you're raising on a note, we don't know what the price of the round is. So you don't know how much of the company you're giving away. And that is the one downside of a convertible note or a safe, is that the price doesn't come in until way later. And so what happens is, say you build that rocket ship and in the next round you raise and it's priced at $40 million, but all of a sudden you gave away so much of your company at sort of 5 million cap, 7 million cap, 9 million cap. So that's why convertible notes might not be great for you because you just don't know how much of the company that you gave away, and you all of a sudden added up all the convertible notes, oh, I gave away 40% of my company, I had no idea. In terms of valuation, how do VCs value your company? It really is both an art and a science. At the earliest stages, it's much, much more art, right? It's a feeling that we have about you, the company, the market, how hot it is. But at the later stages, that really is when real traction, real revenue come into play, the growth rates, the net negative churn if you're a SaaS business. But then, even then, it's not all about the revenue, right? Like, it's like, do I think that this is going to be a competitive round? Do I believe that there might be multiple term sheets? Or if that is, I want to, it's like selling a house, right? Like, you're going to get sort of all the bids in at once, and you want to be competitive. So maybe I'm willing to pay up a little bit more in order to be competitive with the other term sheets. Okay, but the pro tip there is that if you are building a rocket ship and you get multiple term sheets, don't go for the high valuation that isn't sort of a valuation that you can grow into, right? And I will tell you that we have one company today that we put money into the Series A. They raised a huge Series B round of 130 million post, and they couldn't grow into their valuation, and they weren't able to sort of raise the next round. They were looking at a down round, but they couldn't successfully close it because they weren't able to grow into that valuation, and they just recently did a round of layoffs. So that's unfortunate. Had they raised a much smaller amount at a smaller valuation, they would have easily been able to raise enough round because they have 10 million in ARR. At this point, they're sort of working towards profitability because they weren't able to raise the next round. So don't get ahead of where you are traction-wise. Yeah.
What's your preference, lead or basically?
Yeah, so for us, we lead and we take board seats. But it's a good question to research before you go into any VC meeting, and if you're still not clear, then you can ask the VC. So be prepared for lots of rejections. I already went through it, but also manage your the roller coaster of emotions that you'll go through. Because fundraising will be the hardest thing that you'll ever do. You want to carve out that time, schedule it, get some exercise in, maybe do some meditation, get a moment of zen, because it is just going to be this roller coaster sort of emotional journey for you. So just make sure that you manage that. I already mentioned about getting your data room ready. If there's something weird going on about the company, be upfront with your investor about it, right? So a co-founder who you started the company with left a year ago, don't try to hide that. If you took some money from Russia, like way back, in your early pre-seed days, don't try to hide that, right? Like, if you try to hide weird stuff, the VCs start asking, okay, well, what else are they hiding from me? And it doesn't make you look good. I won't go through negotiations just because we're out of time, but I love, if you haven't already gotten the book, Venture Deals, they go through all of the term sheet deals and how to understand sort of all of the different terms in term sheet. And then the pro tip that I have for you here is definitely reference check investors. So the saying, most VC relationships last longer than most marriages. You're going to be with the VC for 10 years. You really do want to diligence them. You don't want to get in bed with a jerk. And so you're going to sort of ask the VC once they drop the term sheet, okay, introduce me to five founders in your portfolio. 2 or 3 where it was, things were going great, but 2 or 3 where the shit hit the fan, right? Like they weren't able to raise their next round. They got hired for sort of below the original valuation or whatever it might be, and you want to try to get those reference checks in. Okay, with that, I think we're out of time. Maybe do we have time for 1 more or 2 more questions or no?
Sure.
Okay, 1 or 2 more questions?
Quick questions.
Okay, right there in the back.
Keep in mind there if
You were talking about valuation. How are the VCs doing the pricing compared to what they would find out on the 409A? Like, are they going by 409A that the company do, or they don't?
So for us, we will price the round. And I would recommend that the founders, unless you're doing a pre-seed round with a cap note or a valuation cap, you shouldn't really price the round. Like, the VCs will kind of determine based on your revenues, based on sort of other factors, like what the right valuation is. You're not expected to know the valuation. If a VC asks you what valuation are you targeting, I actually would be a little bit cagey about it, and just sort of say, hey, we're entertaining term sheets in the next few weeks. We believe that the market will let us know what the right valuation of the company is. But this is sort of what we need to raise to get to make progress in the next 18 to 24 months to hit our next set of milestones. So I wouldn't start talking price with the VCs. It's different when you're raising off of a convertible note. That's when you might set a valuation cap. But when you're getting in front of VCs and almost all VCs want to do price rounds, you let the VCs determine the valuation.
So they dictate the valuation.
Yes.
But you could come back if they.
You can
put out an
negotiate.
offer,
Yes. So
then
when
negotiate.
they give you the term sheet, you can negotiate. Now you're going to be in a stronger position if you have multiple term sheets and create a little bit of a marketplace sort of bidding war, it would be a little bit tougher if it was the only term sheet, but you can negotiate. There's a lot of things to negotiate in the term sheet, and that book, Brad Feld's book, Venture Deals, goes through a lot of like how you handle negotiations. Okay, one more question before I get in trouble by Sheila. Yes, question.
I'm all set. On that point, I was going to say, what's the best advice you can give founders to kind of tackle VCs in the negotiation phase? Like, I understand reading the book, but
Yeah.
you guys are seasoned professionals and know how
Yeah.
to negotiate. So how can founders kind of get
Hire lawyers, and they're going to help negotiate on your behalf, right? On that sort of initial phone call with the VC, because the VC will often have just like you're getting an offer from a company, right? Like it's going to be a phone conversation first, where you're going to sort of talk a little bit about the terms, and the VC is going to try to understand sort of what's your walk away point. You know, like are you happy with the valuation? So they're going to sort of assess sort of where you are. But before you say yes to anything, you're going to consult your lawyers. You're going to talk through, and you're going to share with your lawyers, like, you know, what is important to you, what's not so important, what's your walk away point, and they can sort of also talk lawyer to lawyer. So, okay.
That is a good note to end on. Thank you.